Somewhere in Texas right now, a young couple is sitting at their kitchen table with a mortgage pre-approval letter in front of them, and the number on that letter is higher than it was 3 weeks ago, even though nothing about their income, their credit score, or their down payment has changed. That's not a glitch. That's not their lender being unfair. That's something bigger happening thousands of miles away, in oil fields and bond markets they've never thought about, quietly reaching into their bank account. Because this week, mortgage rates just climbed to their highest level in almost a year, and if you are even thinking about buying a home, refinancing, or just understanding why your neighbor's monthly payment looks nothing like yours, you need to understand exactly what's driving this, because the reason is stranger and more important than most people realize. Before we get into it, do me a quick favor and hit like on this video, and if you're new here, subscribe, because we're about to walk through something that affects almost every American household, whether you own a home yet or not. Let's start with the number itself, because it matters. The average rate on a 30-year fixed mortgage has pushed up to somewhere in the high 6% range, the highest it's been in about 11 months, according to Freddie Mac's weekly survey. To put that in plain English, if you're borrowing money to buy a house, the bank is now charging you more in interest than it has at almost any point in the past year. And this isn't some tiny, meaningless move either. Just a few months ago, back in the spring, rates had actually dipped to their lowest point of the year, giving buyers a small window of hope. That window appears to be closing, and a lot of people don't understand why. Here's the part that surprises most people the first time they hear it. Mortgage rates are not set by your bank, sitting in a room deciding what number sounds fair. They are not directly controlled by the Federal Reserve either, even though almost everyone assumes that. Mortgage rates move with the bond market, specifically something called the 10-year Treasury yield, and that yield has been climbing for weeks. So to understand your mortgage payment, you actually have to understand what's happening with government bonds, which sounds boring until you realize bonds are reacting to something that touches every single American. The price of oil. Picture this for a second. Somewhere in the Middle East, tensions between the United States, Israel, and Iran have flared up again, and oil prices have spiked as a result. Now, you might be thinking, what does a conflict overseas have to do with whether I can afford a house in Ohio? But here's where the story gets interesting, because energy prices feed directly into inflation, and inflation is the single biggest fear haunting the bond market right now. When oil gets more expensive, it costs more to ship goods, more to manufacture products, more to fuel the trucks that bring food to your grocery store. All of that shows up, eventually, in the prices you pay for everyday things. And when investors who buy bonds start to worry that inflation is heating back up, they demand a higher return to compensate for the risk of holding that bond over the next 10 or 30 years. Higher bond yields mean higher mortgage rates. It's a chain reaction, and most homebuyers never even see the first link. This is where it gets almost ironic, because just weeks before this spike, there had actually been some good news. The Consumer Price Index, the main measure of inflation in this country, showed one of its largest monthly improvements in years. For a moment, it looked like the Federal Reserve might finally have room to ease up, and mortgage rates ticked down in response. Buyers who had been sitting on the sidelines started to come back into the market. But that relief was short-lived, because that encouraging inflation data was measuring June, a month when fuel prices happened to be unusually low. July told a completely different story, with gas prices jumping right back toward their highs for the year. And the bond market, which is famously forward-looking, immediately priced in the risk that inflation could reaccelerate. It's a brutal reminder that, in personal finance, one good month rarely means the problem is solved. Now, here's a question worth sitting with for a moment. If inflation cooled off in June, why didn't the Federal Reserve just cut interest rates and give homebuyers a break? This is where so many people get confused. And it's worth clearing up right now, because it will change how you think about every headline you read about the Fed. The Federal Reserve controls something called the federal funds rate, which is essentially the interest rate banks charge each other for extremely short-term loans, often overnight. That rate does influence mortgage rates indirectly, but it is not the same thing, and a mortgage is a completely different animal because it's a long-term loan, and lenders have to think about inflation risk over 10, 20, 30 years, not overnight. The Fed has actually held its benchmark rate steady in recent meetings, a decision described as unanimous, essentially saying they're not ready to cut yet because they're still worried inflation could flare back up. Some analysts are even starting to whisper about the possibility that the Fed's next move could be a hike rather than a cut, which would have seemed unthinkable to most people just a few months ago. Let's pause here, because I want you to really absorb what this means for an ordinary family. Consider the math on a typical home right now. The median price of an existing home sold recently sits somewhere around $440,000. If a family puts 20% down and finances the rest at a rate in the high 6% range, their monthly principal and interest payment lands somewhere around $2,200 a month. Compare that to the median family income in this country, And that single housing payment eats up roughly a quarter of a typical household's entire monthly earnings before you even add property taxes, insurance, and maintenance. That's the kind of number that quietly reshapes people's life decisions, whether it's delaying a wedding, staying in a smaller apartment longer than planned, or turning down a job offer in a different city because the math on relocating just doesn't work anymore. But here's what almost nobody talks about when they cover this story, and it's the detail that changes how you should think about the whole situation. Not every type of mortgage is moving in the same direction. While the standard 30-year fixed rate for conforming loans has been climbing, jumbo mortgages, the loans used for higher-priced homes that exceed conforming loan limits, have actually been drifting the opposite way, dropping to the mid-6% range in some recent readings. Meanwhile, adjustable rate mortgages, the loans where your rate can reset after an initial fixed period, have been climbing too, and more borrowers have started applying for them anyway, with their share of total mortgage applications ticking upward. Why would anyone choose a loan with a rate that could rise later in an environment where rates are already elevated? The answer says a lot about how squeezed some buyers feel. For some, even a slightly lower introductory rate on an ARM is the only way to make the monthly payment work today, a bet that rates will eventually come back down before their adjustment period kicks in. It's a strategy that has burned plenty of borrowers throughout history, and we'll come back to exactly why in a moment. Let's rewind for a second, because history has a lot to teach us here, and it explains why so many people are anxious right now, even though today's rates are, historically speaking, not actually that extreme. If you bought a home in the early 1980s, you might remember, or your parents might remember, mortgage rates that touched the high teens, an almost unthinkable number by today's standards. Rates in the high sixes, the level we're at now, would have seemed like a dream back then. But most Americans buying homes today weren't shopping for mortgages in the 1980s. They were shopping in the years following the 2008 financial crisis, and especially during the pandemic, when rates fell to historic lows, at one point dropping below 3% for a 30-year fixed loan. An entire generation of homebuyers got used to borrowing money at rates that, in the full sweep of history, were almost freakishly cheap. That means today's rates don't feel high because of some objective historical standard. They feel high because of the anchor point people are comparing them to. And that anchor point happened to be one of the most unusual periods in mortgage history. This anchoring effect is a well-documented piece of behavioral finance, and it explains a strange phenomenon happening in the housing market right now, the lock-in effect. Millions of homeowners across the country refinanced or bought during that ultra-low rate window, and many of them are sitting on mortgages at 3, 4, or 5%. Selling their current home and buying a new one, even a smaller one, would mean giving up that old rate and taking on a new loan at today's higher rate, sometimes doubling their monthly interest cost on a similar-sized loan. So instead of moving, many of them are simply staying put, even if their current home no longer fits their life, whether they've had more kids, taken a new job in a different city, or simply want to downsize as empty nesters. This is a major reason inventory has stayed tight even while rates have kept plenty of buyers away, and it's one of those overlooked details that explains why the housing market feels so frozen and so competitive at the same time. Now let's talk about what's actually happening on the ground, because the data tells an interesting and slightly contradictory story. You might expect that when mortgage rates hit an 11-month high, buyers would simply vanish from the market. And for a moment, that's exactly what happened. Purchase applications tumbled the week rates first spiked toward this level. But then, something unexpected occurred. The following week, purchase applications actually rose again, even with rates still elevated, essentially matching where they were a year earlier. What does that tell us? It tells us that a meaningful slice of buyers out there aren't purely rate-driven. They're driven by life events, a growing family, a job relocation, a lease that's expiring, and at some point, waiting for the perfect rate stops being realistic and people simply move forward with their lives. This is an incredibly important lesson in behavioral finance that applies far beyond mortgages. Waiting indefinitely for perfect conditions often costs people more in stress and in missed opportunities than simply adapting to the conditions that actually exist. Meanwhile, refinancing tells a slightly different story. Even with rates elevated, refinance applications have actually been climbing, running well above where they were a year ago. That seems backwards at first. Why would people refinance into a higher rate? But dig one layer deeper, and it makes complete sense. A large portion of that activity is coming from FHA and VA refinances, along with cash-out refinances, where homeowners aren't necessarily chasing a lower rate at all. Instead, they're tapping into the substantial equity they've built up as home values climbed dramatically over the past several years, pulling cash out for renovations, debt consolidation, or other financial needs, even if it means accepting a higher rate on the new loan. It's a reminder that a mortgage isn't just a way to buy a house, it's also a financial tool people use strategically throughout their lives. And headlines about rates rising don't always tell the full story of what's happening inside people's financial decisions. Here's another twist that catches people off guard, and it circles back to that earlier question about home prices. You'd think that with borrowing more expensive and buyers more hesitant, home prices would be falling across the board. In some places, they actually are cooling. Nationally, home price growth has slowed to its weakest pace in more than a decade outside of the outright declines seen after the 2008 crash. But zoom into specific cities, and the picture flips entirely. Certain metro areas, including San Francisco, Pittsburgh, and West Palm Beach, have posted some of the largest annual price gains in the entire country, with sales in some of those markets jumping more than 20% year over year. This is the part almost nobody talks about. National averages can completely hide what's actually happening in your specific city or neighborhood. If you're only watching national headlines, you could be making a home buying decision based on data that has almost nothing to do with your actual local market. At the same time, there's a warning sign underneath the surface that deserves real attention, because it's the kind of detail that can get buried under all the noise about rates and home prices. Foreclosure filings have been rising, up more than 20% compared to the same period last year. That doesn't mean we're heading toward another 2008-style crisis. The underlying causes are completely different this time. Homeowners overall have far more equity cushion than they did back then. But it does tell you something important about the financial strain building underneath the surface for a segment of homeowners who bought at the peak of prices, sometimes with adjustable rate loans, and are now getting squeezed by both elevated payments and a job market that has softened in certain sectors. This is exactly the kind of overlooked detail that separates someone who understands the full picture from someone who only reads the headline number on a rate chart. So what does all of this actually mean if you're sitting there right now trying to decide whether to buy a home, wait, refinance, or just keep renting? Let's walk through it honestly, because there's no single right answer, only the right process for figuring out your own answer. The first mistake people make is trying to time the mortgage market like they'd time a stock. They wait for the perfect rate, convinced that if they just hold off a few more months, everything will line up. But mortgage rates are influenced by forces including oil prices, geopolitical conflicts, and inflation data. It's a level of complexity where nobody, not economists, not bond traders, not your cousin who works in real estate, can consistently predict the next move with confidence. One respected chief economist recently put it simply: rather than trying to guess where rates will land months from now, buyers are far better served focusing on the full, real cost of owning the home in front of them today. That doesn't mean rates don't matter, they absolutely do, especially over the life of a 30-year loan, where even half a percentage point can mean tens of thousands of dollars in extra interest paid. But it does mean the smarter approach is to control what you can actually control. Shop around aggressively between multiple lenders, because rates can vary meaningfully from one lender to another for the exact same borrower, and that gap alone can be worth real money over the life of the loan. Get quotes on the same day. Compare not just the interest rate, but the closing costs and fees baked into each offer. And understand that a slightly higher rate with dramatically lower fees might actually save you money if you don't plan to stay in the home for decades. Look closely at your own timeline too, because if there's a real chance you'll move again within 5 to 7 years, an adjustable rate mortgage with a lower initial rate might make more sense than locking into a 30-year fixed rate designed for someone who plans to stay forever. And if you already own a home with a rate you locked in years ago, resist the emotional pull to refinance just because rates dip slightly. Run the actual math on how many months it takes to recoup the closing costs before that decision makes sense. There's also a quieter lesson buried in all of this, one that applies far beyond mortgages, and it's about patience versus paralysis. The families who moved forward with a home purchase during the week rates spiked toward their highest point in 11 months weren't reckless, and they weren't unlucky either. Many of them simply recognized that their own life circumstances, not a headline number on a financial news site, were the right reason to act. Meanwhile, the families who are staying locked into homes that no longer fit their needs, purely because they can't stomach giving up a 3% rate for a 7% one, are making a completely rational decision too. There's no universal right answer here, only the right answer for your specific number, your specific timeline, and your specific life. If there's one thing worth remembering after all of this, it's that a mortgage rate is never just a mortgage rate. It's oil prices in a region thousands of miles away. It's a bond investor in New York deciding how much risk they're willing to accept. It's a Federal Reserve Committee weighing inflation data from a month that might not even represent what's actually happening right now. All of it eventually lands on that one number sitting at the top of your loan estimate, the number that decides whether your monthly payment feels manageable or suffocating. Understanding that chain doesn't just make you a smarter homebuyer, it makes you a more confident one. Because you stop reacting to scary headlines and start recognizing the actual forces at play, and more importantly, which of those forces you can plan around and which ones you simply have to accept and adapt to. there's one more piece of this puzzle worth sitting with, because it's the part that quietly determines how long this elevated rate environment might actually last. A lot of people assume the Federal Reserve simply reacts to whatever number the government publishes each month. But in reality, the Fed is trying to look several steps ahead, weighing not just where inflation is today, but where it's likely headed over the next 6 to 12 months. That's precisely why the encouraging inflation report from June didn't immediately translate into rate cuts. The committee members know that a single good month, especially one distorted by unusually low fuel prices, can reverse itself just as quickly as it appeared. And that's exactly what happened, because by mid-July, energy prices had already jumped back toward their highest levels of the year, driven by the same geopolitical tensions that started this entire chain reaction. If you're waiting for a rate cut to make your home purchase decision, understand that the Fed isn't just watching last month's data, it's trying to game out a moving target, and that target has been shifting almost weekly. This uncertainty creates a strange psychological trap for buyers, one that behavioral economists have studied for decades in all kinds of financial decisions, not just housing. It's called the anticipation of regret, and it works like this. Buyers become so afraid of locking in a rate today only to see it drop next month that they freeze entirely, sometimes for a year or more, even as home prices in their market continue climbing during that same stretch. The irony is that many of those same buyers would have happily accepted today's rate a year ago, before they got anchored to the idea that rates should be lower. Meanwhile, the home they were eyeing has appreciated, their rent has increased, and they've effectively paid a price for waiting that often outweighs whatever savings they were hoping to capture. This doesn't mean you should rush into a purchase you can't comfortably afford, but it does mean it's worth being honest with yourself about whether you're making a decision based on your actual financial situation or based on a number you're hoping to see on a screen someday. It's also worth understanding how lenders themselves are adjusting to this environment, because it changes what kind of conversations you should be having when you actually sit down to shop for a loan. With the spread between conforming loan rates and jumbo loan rates narrowing, and in some recent weeks even inverting, lenders competing for higher balance borrowers have been getting more aggressive on pricing for those loans specifically. That's a direct result of banks trying to attract borrowers with larger loan balances and stronger financial profiles, essentially competing harder for the customers they see as lower risk. If you happen to be shopping in a price range near the conforming loan limit, this is exactly the kind of detail a knowledgeable loan officer should be walking you through, because the standard rate advertised on a lender's website might not reflect the best deal actually available for your specific loan size. So here's the real takeaway. Rates hitting an 11-month high isn't a reason to panic, and it isn't a reason to assume the housing market is broken. It's a signal, one piece of a much bigger and more interesting puzzle involving energy markets, inflation psychology, and a housing market still working through the aftershocks of the lowest borrowing costs in modern history. If you're standing at that kitchen table right now, staring at your own pre-approval letter, the smartest move isn't to obsess over whether you caught the market at its best moment. It's to understand exactly why that number is what it is, and to make your decision based on your own life, your own math, and your own timeline, not a headline. I'd genuinely love to hear from you on this one. Are you holding off on buying right now because of these rates, or are you moving forward anyway because life doesn't wait for the perfect number? Drop your experience in the comments. I read every single one, and this community has some of the smartest, most honest conversations about money I've seen anywhere on this platform. If this video helped you understand what's actually driving your mortgage rate, hit like, subscribe if you haven't already, and turn on notifications so you don't miss what's coming next, because the story of where rates go from here is far from over, and the next chapter might surprise you even more than this one did.